Hello there, Hector Davil here. Today I want to teach you, or I want to share with you, one specific price pattern, one specific trading technique that's very dear to me. And it's dear to me because it's made me thousands of pips over the years. Okay, it's one of my most profitable, or maybe one of my, let's say, my favorite trading technique, which is precisely why I like to share it with you guys. Alright, let's get started. Alright, the name of the pattern is the Breakout, Congestion, Continuation pattern. Okay, again, Breakout, Congestion, Continuation pattern. As you can see, it's a three-step pattern. It's based, or is built up around three individual candles or three individual price bars. Now, like any other strategy, like any other technique that's entirely based around price action, it's valid no matter the time frame and no matter the currency pair. That means that you can indeed find this price pattern on 1 hour charts, on 4 hour charts, on weekly charts, and on any currency pair. Okay, now that being said, I usually score better results when I trade this particular price pattern on the longer time frames, okay, such as the daily and the weekly. Those are my two favorite time frames when it comes to trade the breakout, congestion, continuation pattern. Alright, so again, it's valid and it's profitable on any time frame, but you will probably score your best results on the daily and weekly time frame. Alright? Okay, now, as already established, this is a candlestick pattern, a candlestick formation, alright? Or price bar formation if you would rather plot your charts in bars instead of candles. Now, for all of you who may not be familiar with candlestick formations, I will just say that it's a combination, and a specific combination of different candles that combine together in such a shape that occasionally gives us a clue or a hint as per the very next upcoming price move, and therefore we'll be able to profit from that upcoming move. Okay, again, you get a combination of different bars, usually 2, 3, 4 different candlesticks together, and depending on how those few different candles combine, depending on the shape of such combination, we can usually have an educated guess as per whether the next move is going to be up or down, and obviously we are going to be trying to profit from that up or down move. Okay? Anyway, if that wasn't confusing enough, wait until you hear this. This particular price pattern is based on momentum breakouts of key levels of support and resistance. Now, I'll repeat that. We are going to be waiting for momentum breakouts of key levels of support and resistance. And support and resistance is the key concept here. Okay? We need a key level of support and resistance in place before we can actually search for the breakout, congestion, continuation pattern. Alright? Now, that key level of support and resistance can take any shape, and I really mean any shape. We can be searching for breakout, congestion, continuation patterns upon the breakout of a trend line. Alright, let's imagine we have price swinging right off a diagonal level of support and resistance, which is basically the definition of a trend line. Okay, a diagonal level of support and resistance. Resistance in this case, since price finds resistance of that specific line. Alright, every time price touches that trend line, price bounces off of that diagonal level of support and resistance. Okay, well, so what we are going to be waiting is for momentum breakouts of that level of support and resistance. That means that we need to wait for the trend line to actually break before we can search for our specific pattern. Alright, now that particular level of support and resistance can also take the shape of a range boundary. What's a range? Well, a range is basically a sideways congestion area where price is entrapped within. Okay, I'm sure you've seen plenty of times in your charts, occasions in which price seems to be just flip-flopping sideways and trapped within two horizontal boundaries, well, those are our two key levels of support and resistance on that junction, at that junction of the chart. So what are we to do? Well, we are to wait for the breakout of either of the two boundaries, either the upper boundary or the lower boundary. And once the breakout takes place, then we can begin searching for our breakout congestion continuation pattern. Another shape that we can see this particular pattern developing from a previous swing high and low. Let's imagine price had hit a final swing high. Okay, from there we retrace down hard, and next time price comes back to retest that particular level, well, if we get a breakout, then we are okay. We have the thumbs up, the green lights to search for our breakout congestion continuation pattern. Okay. Again, we have a swing point, a previous swing point in our chart. We mark that level with a horizontal line, and we wait to see for the breakout of that specific level before we can search for our specific pattern. All right. And finally, actually, the type of price formation that's given me the best result over the year, flat bottom or flat top triangles. Obviously, this is a triangle, right? This is a standard triangle where price simply compresses sideways towards the vortex of the triangle. Okay, but on occasion we get what I call a flat top triangle, where price bangs onto one specific level, okay, this horizontal level there, but it usually prints higher swing lows, building pressure upon this specific flat line or flat level, and eventually this level cannot hold the pressure anymore, and bang, eventually it breaks in momentum, and that's the very best location to search for breakout congestion continuation patterns. Again, in my experience, flat top triangles or flat bottom triangle, it works either way. Okay, something like this, where price is compressing towards one flat line, one level of support. In this case, we'll be waiting for the breakout of that flat line in the direction of the market pressure. Okay, please notice how price is printing lower swing highs, and therefore it means that price is building pressure upon that level. Once that level gives way, we usually see beautiful, and I mean beautiful, continuation moves. Okay, and that's exactly when you want to be ready in order to profit from those continuation moves. Okay. And well, finally, I need to state that this is going to be a continuation pattern. All right, we are going to be trading continuation moves. Some other candlestick formations are reversal patterns, where you search for one specific pattern in order to identify a potential reversal moves. Right? Well, this is not the case. This specific price pattern, this specific candlestick formation searches for continuation moves. Okay, so you are going to be trading in the direction of the breakout, in the direction of the upcoming move prior the pattern in itself. All right, so again, continuation move as opposed to a reversal move. Anyway, we are now ready. We have the basics in place. We are now ready to start trading or start reviewing the pattern in itself. Let's get going. Okie dokie, for the sake of discussion, I'm gonna base this presentation around the breakout of a sideways price action, or what's the same as sideways range, alright? Where price breaks free of this range with these two horizontal boundaries, and obviously price simply swinging up and down between those two levels of support and resistance. Okay, as I was mentioning before, we could equally search our breakout congestion continuation pattern upon the breakout of a flat bottom triangle, all right, or the breakout of a previous swing high. All right, or also a trend line, etc., etc. But again, just for the sake of discussion, I'm gonna base the presentation around the hypothetical case of a range breakout. Okay, and more specific, the breakout, a breakout to the upside, a breakout of the upper range boundary. Okay, first step into this pattern, the breakout. We want to see a full body candle leading the breakout. That means that as price is breaking through that key level of support and resistance, we need to see momentum. Remember earlier on in this presentation when I was saying that this strategy is all based around momentum breakouts of key levels of support and resistance, right? Well, we do have our key level of support and resistance. Now we need to see the momentum in the breakout. And how do we identify momentum in a breakout? Well, by the shape of the breakout candle in itself. We want the breakout candle to be made up, or the majority of the candle to be made up by the actual body of the candle. That means that it needs to be a long candle with short wicks both up and down, meaning that the majority of the candle again is formed by the actual body, okay? The body of the candle in itself. So, if upon the breakout, around breakout levels, instead of seeing this long, solid, heavy momentum breakout candle, what we see is actually something like this, right? A candle where, well, the size of the body is rather small if compared to the total size of the candle. Well, this is obviously not a valid breakout candle. Or something like this, where the wick, either the upper wick or the longer wick, this time around is just the upper wick, but at any rate, if any of the wicks is much larger than the body in itself, that's not a valid candle either. At the end of the day, please remember what I mentioned before. This is a continuation pattern, okay? We are going to be profiting out of the continuation part of this breakout congestion continuation pattern. So, if there is no momentum, if there is no trading volume pushing the breakout through, do you reckon we are going to get any continuation move at all? Well, chances are that no, we will not get a continuation move unless we see a heavy breakout. Okay? Again, that's why we are to require from our setups to see a solid, long, full body candle as price is breaking through that key level of support and resistance. Alright? Anyway, enough of beating that horse. Let me take off those two candles, and now let's move into the congestion part of the pattern. We want to see a congestion bar after the breakout. Okay, congestion bar. We want to see a small candle with a small body and small wicks both up and down. Okay, this particular candle can take the shape of a spinning top, which is it's, you know, in the forex lingo how we call small candles with a small body and also small wicks both up and down, or even a doji. A doji is a candle that takes the shape of a cross, where the open and the close of the candle fall in line, and therefore the candle as a whole shapes up as a cross. Okay, but like I say, at any rate, it needs to be a small candle, no matter the color of the body. Okay, that's why I colored it in gray. It doesn't matter whether it's a green or a red candle, since at the end of the day it's so small. It means that more or less the candle opens and closes at around the same level. That's why it's a congestion candle. Market upon the breakout, I mean the idea here, the nature of this price action or this price formation is that upon the breakout, the market is taking a breather, is gathering or regaining some momentum for a second push. Obviously, as you probably guessed, this second push is going to be the continuation, and that's where we are going to make our money, right? But at any rate, let's go one step at a time. The idea here is that the market is regaining some momentum up on the breakout for a second push, obviously in the direction of the breakout, right, of the original breakout. And therefore, that's why we want to see a small candle. You don't want to see another long candle here with a long body, none of that, okay? Small candle there, guys. And also, the second requirement of this congestion bar, not only it has to be small, but also it has to go, or it has to form totally above or beyond breakout points. So you don't want this candle to fall back below. So let me actually select this candle. You don't want this candle to go back, beyond breakout points. Okay, that's not a good thing. That's not a good market event. What you want to see is price remaining above breakout points for the entire candle. Do you see that? How price opens and closes above that breakout point? That's what you want to see. You don't want price to fall back within or below that level of support and resistance, okay, that breakout point. All right, those are the two requirements for this congestion bar. A, small candle, and B, taking place at any time beyond breakout point. Now, moving on with the presentation, we are also going to be using this congestion candle as our trigger bar. And in order to do that, we are just going to be bracketing that candle, okay? As this bar closes, as this candle closes, okay? Right there, as it closes, we are going to go ahead and bracket the candle for both our entry and our stop loss. Again, as the candle closes, our entry is going to be, we are going to select, or we are going to place on our broker a buy stop pending order 5 pips above the high of that congestion candle. Again, 5 pips above the high of the candle, we are going to place our buy stop pending order. And our stop loss is just going to go 5 pips below the low of the candle. All right, so as price breaks through on the continuation candle, we are, or our broker is going to be automatically executing our pending order, and therefore we are going to be filled long on the market. Okay, if up on the next candle price dives back within the range or breaks below our stop loss level, we are simply going to manually cancel our buy order. All right, this pending order is a floating order. It's an order that is not executed unless price breaks through that level. If it doesn't, if instead, again, price simply moves down as on the upcoming candle, if instead of getting a continuation, what we get is a reversal, we go ahead and manually cancel that pending order. All right? But anyway, assuming everything goes as expected, and indeed we do get a continuation candle, right? Should look something like this. This continuation candle is usually more or less as long as the breakout candle in itself. That's been my experience. Okay, we usually get, depending on how solid the breakout was, so will be the continuation. That's why I was mentioning before that you want to see a solid breakout to ensure that we are also going to get a solid continuation move. Okay, we're going to use the continuation candle to close the trade, or at least the majority or a large portion of the trade. Okay, as this continuation candle closes right there, if you are, for example, trading off the daily time frame, well, you simply come back at the end of the day, wait for the candle to close, and wherever it closes, that's where you close a percentage of the trade. All right? Now, the reason as of why we don't close 100% of the trade at the close of that first, that first continuation bar is because we usually see momentum enough for a second continuation bar. Again, depending on how solid that first breakout was, right? But at any rate, in my experience, if this was a valid breakout, we usually see momentum for a second continuation push. Now, please mind how the total size of this, second push is smaller than the first one, okay? And I've done that in purpose because in my experience, again, the momentum is already weakening by the second continuation candle. All right. At the end of the day, momentum is not endless. All right. We cannot expect to see trading volume pushing price on one particular direction forever and ever. Okay, that doesn't happen. Momentum eventually dies out in the market. Well, in my experience, momentum usually lasts for, or is good enough for a second push, but we are already seeing an early signal of a slowing down in that momentum. Okay, and therefore this second bar is usually smaller than the first one. So we are to close a percentage of the trade at the close of the first candle, leaving a second portion of the trade running in the market for further profits. We can either close 50% there and 50% there. Let's imagine you took your entry right there with 4 lots. Well, you would go ahead and close 2 lots there and another 2 lots at the close of the second candle. Or if you are a little bit more conservative, you may close 66% at the close of the first candle and then 33% at the close, or 34% to be accurate, at the close of the second candle. All right, that depends on how aggressive or conservative you are, either 50 and 50, or again, if you are more conservative, 66 and 33. All right. Let me actually mark the profit-taking levels there. First level at the close of the first candle, second level at the close of the second candle. Now, what you can also do as price hits your first level and therefore as you close either 50 or 66% of your lot size, it doesn't really matter. What you can do is to trail your stop loss to break even. Okay, right there. You trail your stop loss to break even in order to offset the risk on this trade. So, should we not see momentum enough for a second push, and instead of that second push, if we do get eventually, if we do indeed get a reversal, well, at least we've minimized the risk altogether into that trade, and price or our stop loss will be hit at break even. Therefore, we will secure profits on the first portion of the trade, and well, we will score no loss whatsoever on the second portion of the trade. That's usually a good idea. A healthy trading procedure, so to speak. Secure some profits earlier on in the trade, also offset the risk as soon as possible, and then leave a remaining portion of the trade running in the market, who knows, for potential further profits. Again, that's usually a sensible approach to Forex trading. Alright, let's now take a look into an actual live Forex example that happened not long ago, actually, on the sterling pound against the American dollar. Weekly time frame, we see how price had a nice rally up, but from there on, price entered some sort of a sideways price action. Do you see how price had been moving more or less sideways? Well, that's more or less a range, isn't it? So we can define the range boundaries, okay? Both to the downside and to the upside. Okay, and obviously our job as a trader is to wait for the breakout, right? Well, let me define the range boundaries. Actually, let me mark it with a horizontal line right there. That's the low of this sideways price action. That's the high, but eventually the breakout took place to the downside, so I am not going to mark the upper boundary. Now, let me zoom in a little bit more into the right end of the chart. This is the breakout candle. Do you see that long, beautiful breakout candle? That's exactly what I was talking about before, guys. You want to see a breakout candle where the majority of the candle is made up by the body, not by the wicks, either the upper wick or the longer wick, but the candle in itself. You want to see this type of candle, such as this one, or maybe this one there. Also, this one would have been a valid breakout candle, etc., etc. Okay, so first requirement, a solid breakout candle. That's all right. Now, later on, we see a nice congestion candle, rather small, and taking place below breakout levels. Okay, it doesn't dive back within the area, okay, within the level of support and resistance. Instead, it remains beyond breakout levels. So that's another requirement that's fulfilled, and therefore once we have all that in place, what are we to do? Well, we are to bracket the congestion area. 5 pips below the low of that congestion area, that would go our sell pending order. Our stop loss would be located in there, 5 pips above the high. And well, as you can see on the next candle, meaning the first continuation push, our sell stop order would have been triggered. Please mind how this is another solid break continuation move. Okay, more or less equal in size as the breakout candle in itself. That's what I was mentioning before. You usually see the continuation candle, more or less equal in size as the breakout candle in itself. So, nice continuation move. As this candle closes, we would have closed out a portion of the trade, either 50 or 66%, depending on our risk profile as a trader, and we would have trailed our stop loss to break even. Okay, and from there we see a second push. Do you see that second push there? We would have closed the remaining portion of the trade right there for further profits. And again, please mind how this second candle is a little bit smaller than the first push. All right, that's normal, guys. That's normal. All right, second continuation push is usually smaller than the first one. And please take a look at the next candles. Do you see how momentum totally faded away? Price simply moved sideways from that point on for the upcoming 2 candles. Again, that's normal. That's why I said before that you don't want to push your chances beyond the second continuation candle, because breakouts have a very short memory span. You usually see momentum, or usually have momentum enough for 2 candles, for 2 continuation candles, but no more than that. All right, so don't search for a third continuation candle. Chances are you are not gonna get that, but at least 2 of them are enough to make your profits, firstly here and then here. Okay, now let me show you another recent example, this time around on the Kiwi, the New Zealand dollar against the Japanese yen, daily time frame, in order to stress the importance of seeing a valid breakout candle. Please take a look at my screen. What are we seeing here? We are seeing another range, clear resistance to the upside, clear support to the downside, price swinging up and down sideways. All right, so what's that, guys? That's a range, isn't it? That's a range. Eventually, price breaks to the upside, okay, breaks or pushes beyond the upper boundary of the range. But take a look at the type of candle. Actually, let me mark the range boundary there with a horizontal line. Please take a look, price action. Take a look at the type of price action we get around breakout point. That's not a valid breakout candle, is it? Let me zoom in a little bit more. Instead, it's a rather wobbly breakout candle. Very ugly, a very ugly candle. Long wicks, both up and down. Very small body. Please take a look at that small, ugly body there. That's not the type of breakout you want to see. This is a hesitation breakout. It's not a momentum breakout, it's a hesitation breakout. And as a consequence, what type of reaction did we get right after? Price dived back within within the range in itself. We didn't see that continuation push we wanted to profit from. Instead, we saw a reversal. So please take always a close look into the breakout candle in itself, because it usually gives us a fantastic indication of whether the breakout is going to pull through or instead is going to reverse on us. All right? Alright guys, this video is already running too long, so it's time to take a break, both you and I. I hope you've enjoyed this breakout congestion continuation strategy. So next time you take or next time you see a breakout of a level of support and resistance on your chart, follow it closely, because if you get a valid breakout candle and a small congestion bar, chances are it's gonna be followed by a continuation push. Alright, so who knows, maybe you may profit from the next from that next opportunity. Alright, okay folks, it was my pleasure to share these moments with you. Cheers and thanks for watching. Bye bye.